Hello everyone, good evening. Welcome to BISP Solutions. So today we are going to discuss under US GAAP Accounting Standard Codification 2110 and Accounting Standard Codification 215. Accounting Standard Codification 2110 stands for balance sheet. Now under this balance sheet we'll have two subtopics. First is Accounting Standard Codification 2110-10, which stands for overall explanation, and second is Accounting Standard Codification 21020, which is offsetting. Okay, so Accounting Standard 2110 balance sheet, it provides journal guidance on the presentation of balance sheet, including classification of current and non-current assets and liabilities, and the conditions for offsetting assets and liabilities on the balance sheet. It establishes the rules for determining working capital by segregating your current items and providing specific criteria for offsetting the amount, such as when a reporting entity has a right to set off the intents to do so. So first, under Accounting Standard Codification 21010 balance sheet presentation, so this subtopic outlines the overall principles for presenting a balance sheet, also known as statement of financial position. It emphasizes on classifying asset and liability into current and non-current category to allow for determination of working capital, because as you will bifurcate your current assets and current liabilities and non-current assets and non-current liability, then you will be able to determine the working capital, because working capital is your current assets minus current liability. So for that you have to bifurcate into assets into, or the break down the asset into current asset and the non-current assets. So I mean, we have assets and we have liabilities. So our purpose is to break down this asset into current assets and non-current assets. Similarly, we'll break down the liability into current liability and non-current liability, which is also known as long-term liability. Current assets and non-current assets. Non-current is a long-term assets, or you can call it as a fixed asset. So why we are bifurcating, so that we can derive the working capital. So working capital, how we derive it? Current assets minus current liability. So if you bifurcate this asset into these two, then it will be easy for us to directly know how much is the current asset, how much is the current liability, and you can derive your working capital. Okay, then second subtopic is Accounting Standard Codification 21020, that is offsetting of assets and liability. This subtopic provides specific guidance on when assets and liabilities can be presented net against each other on the balance sheet. Now there are some conditions for offsetting. Now we'll discuss those conditions for reporting purpose in detail. So let's start with the first codification 21010. So it focuses on presentation aspects of balance sheet, classification of current and non-current assets and liabilities in the operating cycle. When appropriate, balance sheet presentation, it is also permissible if you feel that liquidation is imminent, that you can go ahead with liquidation basis of presenting your balance sheet as well. So this subtopic provides guidance on the overall aspect and the presentation and disclosure of the balance sheet. And the second subtopic, that is 21020 offsetting, this provides guidance on offsetting amount for certain contracts such as derivative contracts and repurchase agreements, which are accounted as collateral borrowings. It provides guidance on netting off or offsetting effects on contracts. Now we'll see one example on balance sheet, or we can start with offsetting. Okay, so here we have two. First is overall, that's your balance sheet, and second you have offsetting. So we'll start with the balance sheet. Now balance sheet, we have already seen, or I've already discussed that it focus on presentation as aspects of balance sheet, classification of current assets and non-current assets and non-current liabilities in the operating cycle. Now there are two formats of balance sheet. First is the balanced, second is the equity. Now balanced, that is your mostly used. So first we'll discuss the example, then we'll discuss the format of the balance sheet. Now here balance sheet report the effect of transactions on an aggregate basis at a point in time. That means you can see it is presenting on some particular date, that is 31st December, and year you can say maybe 1993 or 1999, any year you can specify, meaning it displays the information as on date and not for the period. Some statement like for the period which is prepared, like statement like income statement, comprehensive income statement of changes in net assets, the cash flow statement, or the shareholders equity, the statement of shareholders equity, all these are prepared for the period, but balance sheet is prepared as on date. So all these statements show the effect of transactions occurring during a specific period of time, for example month or quarter or year. So there are two, now here you see there are two, it's a bifurcation. On the left you see there are assets, on the right you have total liability and shareholders equity. Now assets is bifurcated into your current assets and your non-current assets, that is your investment and property, plant and equipment and other assets. These all are your non-current assets and one is your current asset. Similarly, your liability and shareholder equity is bifurcated into your current liability and long-term liability, and the sum total will tell you the total liability, and the next portion is your equity, that is your total shareholders equity. And the sum total of your liability and equity will show you here, that is total liability and shareholder equity, and here it will show you total assets, means current assets and non-current assets. Now what is balance sheet? First discuss that. So balance sheet lists a company's assets, liabilities and shareholders equity for an operating period. Balance sheet provide the basis for computing rates of return for the investor, that is rate of return for the investors, and evaluating a company's capital structure. In short, the balance sheet is a financial statement that provides a snapshot of what company owns and owes, as well as the amount invested by the shareholders. Balance sheet can be used with other important financial statements to conduct analysis or to calculate some financial ratios. So balance sheet is one of the three core financial statements that are used to evaluate a business. So it will provide you a snapshot of the company's finances, like what it owns for the past operating period. The balance sheet adheres to a formula in which assets are equal to the sum of liabilities and shareholders equity. That means your left should be equal to your right. It means your assets should be equal to your liability plus equity, or you can even say assets minus liability is equals to your equity, shareholders equity. So this is just I bring the liability on the other side. So this is a simple mathematical formula. So this is your equation and simply how the balance sheet is being prepared. So in which your assets are equal to the sum of the liabilities and shareholder equity. So balance sheet always adheres to that formula. And some analytics who the job is to do the analysis, they use the balance sheet to calculate the financial ratios. Now you must be knowing what is asset, liability, shareholder equity. So I'll just quickly cover assets. is what a company owns. Okay, this is what a company owns. Now it is bifurcated into current assets, and these are the non-current assets. Now current assets, so assets expected to be converted to cash or used up with 1 year of or the operating cycle. That is, you can consider the example as cash, accounts receivable, inventory. Now non-current assets like long-term assets such as property, plant and equipment, and intangible assets which you hold it for more than 1 year, which is need to be converted. If you want to convert it, it will take more than 1 year, so that is your non-current assets. And the conversion time is within 1 year, that is your current assets. Now liabilities, it's what a company owes to others. That's my liability. So that's being bifurcated into current liability and non-current liability. Current liability is the obligation due within 1 year or the operating cycle, like account payable, short-term loans. And non-current liability is long-term debt that are not due within a year, such as long-term loans or bonds payable. Then you have shareholders' equity. As we have discussed assets and liability, then we have shareholders' equity. So this is my shareholders' equity, or you can say the equity. So the owner's stake in the company. This includes items like common stock, retained earnings, treasury stock. Okay, so now what is common stock? So the value of shares which is issued to the common shareholders, that is your common stock. The shares that you issue to these shareholders, that is your, and the fund that you raise from that share is your share capital, that's your common stock. Preferred stock is like the value of shares that you issue to the preferred shareholders. Your additional paid in capital, that is the excess amount that you have received over the per value of stock when it was issued. The excessive amount that you have issued, this is your additional paid in capital. Then retained earnings. So retained earnings is the accumulated net income of the company, not paid out as dividend. Okay, so the dividend has not been paid out. It's nothing but a profit except the dividend. Treasury stock, it's a share of the company's own stock that have been repurchased. And accumulated other comprehensive income is the cumulative income and losses that have not yet been recognized in the income statement, such as unrealized gains or loss on available for sale securities which have not been yet been realized. So you cannot charge it in the income statement or book it as an income because this is yet not occurred. It's not your actual loss or gain. It's that you're recognizing it, not you have booked it. Okay, so that's your that you book it in your other comprehensive income. And here also you put up non-controlling interest, so the portion of equity that belongs to minority shareholders of a subsidiary company. I have not mentioned here, but when you will do the consolidation, the non-controlling interest portion that belongs to the minority shareholders will also come over here under shareholders equity. Non-controlling interest. Okay, so now under current assets we have cash and cash equivalents, trading securities, accounts receivables. That means you have done this is account receivable is nothing but the debtor that you have sold goods to some party on credit. Now that party becomes you book that party as an accounts receivable because you have to receive money for that sales. Then you have notes receivable. Inventory is nothing but a stock, and this is your prepaid expenses. You can assume it as an advertisement expenses. Then you have current portion of long-term debt. That long-term debt is it comes under your long-term liability, but the current portion of it comes under your current liability. Then you have accounts payable, notes payable, interest payable, salaries payable, unearned revenue. These are all your current liabilities. Then that is your long-term assets or the non-current assets is available for sale securities at fair value, held to maturity securities, investment in affiliates. So this we are seeing all the investment that we have done. And then property, plant and equipment, which shows land, building, equipments less accumulated depreciation. Okay, so all the fixed assets will come over here. And under other assets, which is not becoming a part of your investment, PP or current asset, that's your pension asset, deferred income tax asset. Then here under long-term liabilities, we have bonds that they need to be payable, deferred income tax liability, pension liability. These are all your long-term liabilities. Then equity will come over here, which is capital stock, additional paid-in capital, retained earnings, treasury stock, non-current interest. So the sum of the liability and equity should be equal to your total assets. That means total assets should be equal to your total liability and shareholder equity. Left should be equal to your right. Okay, so this was under accounting standard codification 210-10, that is overall presentation of your balance sheet. The second codification is accounting standard codification 2110-20, which denotes offsetting. So offsetting, okay, before proceeding to offsetting, I forgot to discuss that there are two formats of balance sheet. One, it is balanced. So formats of balance sheet are: one, it is balanced format. Second, you have equity format. So the balanced format means it is the mostly used format. It lists assets first, followed by your liabilities and equity vertically, representing your total assets minus total liabilities to arrive at the equity. Okay, so here this follows in a vertical way. So you will have first your assets, then it will be followed by the liability. So in this way it will be followed. So assets, liabilities and equity. But this is under your balanced. But under equity, what I just shown you, that's your equity format. It presents assets on one side, that is on mostly on the left, and liabilities and equity on the other side, that is on right. Mirroring the equation of assets is equals to your liabilities and equity that we just discussed. Okay, this is the same format: assets on the left, liabilities and equity on the right, and your asset should be equal to your total liability and shareholders equity. Okay, so that's your equity format. Balanced format, if you see, let me check if I have that. Yes, this is your assets. When you show an assets, that is your current assets and non-current assets, preceded by your followed by your liabilities and shareholder equity. Okay, so in this way, if you do the presentation, that is your balanced format. And on the left and right, on the left you show assets, on the right you show liability, that is your equity format. Okay, these are the two formats. Now there are three elements, that is on the face of balance sheet that you need to show. First, you need to show the legal name of the entity. Then you need to show the title, that is the statement of financial position or balance sheet. If you're preparing a balance sheet, if you're preparing an income statement, so it will be income statement or statement of income statement, and so on. Then we have to show the date of the statement, that is as on some date, as on date. Okay, so this is that you need to show on the face of the balance sheet. Okay, now proceeding to the next topic, that is offsetting. So offsetting, it's a practice of netting off your assets and liabilities on the balance sheet rather than presenting them on a gross basis. Offsetting is usually presented in a tabular format close to the financial statement. It is majorly applicable to investment companies such as hedge funds and mutual funds. So there is some criteria of offsetting. So when you have to offset, the first, there should be forcible legal agreement. Second, you can offset only when there is a forcible legal agreement. Second, there should be an intent to set off. That means reporting entity has an intention to offset the amount. Without this intention, the offsetting table does not depict faithful element of financial reporting. So there should be an intent to set off. Third, reporting entity has a right to set off the amount. The reporting entity has a right to set off that amount. So it does against the amount which is owned by the other parties. So it is majorly shown by the counterparty agreements. Fourth condition is Now the fourth criteria is amounts can be determined. So these, if it fulfills all the criteria of offsetting, then you can offset it. So it provides a full proof guidance, that is a accounting standard codification provides a full proof guidance to the investment companies who needs to present his offsetting amount in their notes to financial statement. Okay, so as I said, discuss some conditions are there for offsetting. Okay, so for reporting entity to offset assets and liabilities, the following conditions must be met, as we have discussed just now. And there are some examples of offsetting, like if you repurchase and reverse repurchase agreement. So this standard permits the offsetting of amounts recognized as payable in repurchase agreement against the amount recognized as your receivables in reverse repurchase agreement with the same counterparty. So you can offset both those amounts. That means you can offset your receivables with the payables. Outstanding check. A company can offset the positive balance of its main bank account against the negative balance of its disbursement account if all the necessary conditions for set-off are met. Okay. Okay, so here if you see, as we mentioned, we need to show assets and liabilities on net basis, so it's a net amount, and the other statement shows your assets and liabilities in the balance sheet. You have here gross amount and the net amount basis. When you see the balance sheet, it is presented as on date. Okay, right now it is presented as on date. Here also, when you present the offsetting in notes to financial statement, date will be 31st December. This is the standard format for offsetting for all the investment companies to follow. You have the type of financial assets and liabilities. Okay, so that means right now I've considered as forward contracts. Then we have gross amount of recognized financial assets. Then we have gross amounts of recognized financial liabilities, which set off in the statement of financial position. Then we derive at the, when you subtract A minus B, we derive at the net amount of financial assets presented in the financial position. After that, you have financial instruments, which is, this is the related amount not set off in statement. And here you have cash collateral received or pledged, and net you'll get the net amount, which will be a sum total of your C plus D. That's your net amount. Okay, so here you see this is your forward contract, which amounts to 2500. Okay, this is a gross amount of recognized financial asset. That is, in case you have a repurchase agreement, how much collateral has been pledged or received against the contract with that concerned counterparty, you would need to mention over here. Okay, so first is you would have your net amounts being disclosed. Second condition is, against those contracts which are accounted as collateralized borrowing, you have to disclose how much cash collateral have been received or pledged against the those derivative contracts. And after taking into consideration, you have to show net amount. So like in this example, the net amount is 2000. Like one forward contract was there, the gross amount of that was recognized financial asset was 2500, and then you don't have financial liability. So net amount will be 2500. There were no financial instrument like derivatives, ESOPs and all these. There were no financial instruments. Then you have cash collateral received or pledged, that is of negative. So that is of minus 500. So 2500 minus 500 leads to net amount of 2000. Okay, so if you want, like you have forward contracts as an asset. Okay, so you see, that's why I am receiving as an asset. We don't have a liability. If you had liability as well, then it will be shown under liability. This is assets, and if it were liability, it will be shown at the bottom. If you want readers to know about cash collateral, then you can also have footnote with a star mark sign or the asterisk sign, which denotes that there's an additional information which is necessary for the users or readers of the financial statement to know. Then you can assume the example of it is like here. This is your offsetting, how you are offsetting both these amounts, what you have received, what you have paid. We are netting off both the amount, and the net amount is coming to be 2000. This is the offsetting. Now we are taking an example of the classified balance sheet. Look, your current assets or current liabilities, they are reasonably expected to be realized in cash during the operating cycle. If the average period of the time required to carry out day-to-day operations, that is acquisition of cash, to produce goods and sell the goods for cash realization, the time frame to do cash realization and cash acquisition, that period is the operating cycle. Now, as we have already discussed, what is current asset, it should be reasonably expected to be realized in cash or sold in this particular time frame. So we should always focus on the what's the operating cycle. So operating cycle, if it is less than 1 year, then 1 year period is used to distinguish between your current assets from your current liability, or from the non-current assets. But it will distinguish between the current assets and the non-current assets. Now, current liabilities also, business is expecting to settle in cash within the reporting year or reporting cycle of the company. So you can reclassify current liability to your long-term liability, but you should have intent to do that, and you should fulfill the criteria for reclassification. Okay, so this was your balance sheet, and this was your offsetting. You can offset the amount, you'll have gross amount. If you have assets, here you'll show. If you have liabilities, you will show it over here. You'll have gross amount. If the asset, will show it over here. If it's a liability, it will show it over here, and you can net off that amount. And any cash collateral is there, financial instrument amount is there, you'll offset that with the net amount, and you'll still here, that is your net amount. Okay, so this is how you prepare and should be as on date. Now we'll discuss the next one, and these are the criteria of offsetting. Then only you'll be able to offset if all these criteria are fulfilled. Then the next is Accounting Standard Codification 215, that is Statement of Shareholders' Equity. So this topic only contains one subtopic, that is ASC Accounting Standard Codification 215-10. This subtopic provides referral to Accounting Standard Codification 505, that is equity. This shows how statement of shareholder equity look like, what are the components, and how will you read this statement, what are the consistency checks that you will perform. Okay, so this Accounting Standard Codification 215, it's within the US financial, it is within the US GAAP, that contains generally accepted accounting principles for presenting a statement of shareholders' equity. It provides the rules for how companies should report the changes in their equity, including items like common stock, treasury stock, retained earnings, accumulated other comprehensive income. So there are some key aspects of Accounting Standard Codification 215. First is your statement of shareholders' equity. So this standard defines the structure and components of the shareholders' equity section of a company's financial statement. Then it should have the transparency and disclosure point of view. The goal of this Accounting Standard Codification 215 is to ensure that the companies provide clear and transparent information about their equity structure and the changes over time. Now there are various elements of equity. So if we go to the shareholders' equity, statement of shareholders' equity, so there are various elements or various components of equity, like common stock we have discussed, retained earnings, treasury stock, accumulated other comprehensive income. So common stock is the initial investments which is done by the shareholders. Retained earning is accumulated profits of the company that are not distributed as dividends. Treasury stock is shares that a company has repurchased from the market. Accumulated other comprehensive income is unrealized gains or losses not recognized in the income statement, such as from currency translations. And here we'll refer the other topic as well, that is accounting standard codification 505 equity. So this is a summary. We'll discuss more under because the whole separate is the topic is there, ASC 505 equity, which relates to equity. Okay. Okay, so here first you have partners capital. This is for the general partner, this is for the limited partner, this is the statement of shareholder equity, or you can say statement of partners capital. So the partners capital, which is introduced at the beginning of the year by the general partner, is 5,000. The amount introduced by the limited partners is 2,500, and the sum total is 7,500. Then you have capital contribution, that is the amount which is contributed by the partners is known as capital contribution, and that is being done by the limited partners, amounting to 5,000. So in total you have 5,000. Then any capital withdrawals which is done by the any partner of which is there in the company or in the partnership firm, not the company, because it's a partner. So any capital withdrawal, if it is done, so nobody has done the capital withdrawal. Then early redemption fee, so that is early redemption fee, so that stands to negative 1,500, which is charged for the limited partners. So in total it has minus 1,500. So early redemption fee is like if you have invested into fund which follows lock-in period, basically you have some time frame to auto withdraw, but you broken that code and you withdraw it after that time frame. In that case you are entitled to pay fee to the fund manager, that early redemption fee. That's why it shows a negative sign, because it's a fee. And capital contributions, capital withdrawals, and early redemption fee, they all contributes to my capital activity proportion. So these all are my capital activity proportions or capital activity portions. And P&L contributions, this is your allocation of a net income, that is your P&L contribution. Pro rata allocation is there, that is on the basis of pro rata this net profit is getting allocated, that is 3,300 profit is getting allocated, 1,500 is allocating to the general partner, and 1,800 is getting allocated to the limited partners on the pro rata basis. And reallocation, if you are doing to the general partner, is like you are subtracting from here and you are reallocating it to 1,000 to the general partner. So the sum total will be of these two allocation of net income will be 2,500 and 800. In short, it will be 3,300. So how it was bifurcated, 3,300 gets bifurcated to here in this way 1,500 and 1,800. Then reallocation happened, that wrongly it was being charged to limited partners, or maybe at later point of time they thought that general partners should get more share in the net income. So minus 1,000 is being done from here and it gets reclassified to the general partners net income. So the sum total of 1,500 plus 1,000 is 2,500, and 1,800 reduce your 1,000 that you have reallocated it to the general partner, you are left with the 800. So sum total is again 3,300. It should always match. So this is your allocation of a net income. In total you have partners capital, which is at the beginning of the year is, so partners capital total was 7,500. Then again capital contribution was there of 5,000 minus 1,500 early redemption fee was charged, and allocation was 3,300 of the net income. So in total it will have 14,300. That means 7,500 plus 5,000 minus 1,500 plus 3,300, it's 14,300. So this is your sum total of it. So this is how you derive your statement of shareholders equity. Okay, so how much it has been contributed by the partners, who has withdrawn, in total what is the partners capital, what was the net income that was being distributed among the partners. So it shows you here everything in detail. So this first is your capital contribution, this shows your capital capital activity portion, and this shows your P&L contribution. Okay, so P&L contribution is your 3,500. So capital contribution, you can see, so here you see 5,000 minus 1,500 is 3,500 is your capital contribution, but P&L contribution is 3,300. Okay, so this is how you can see the capital contributions and P&L contribution by the partners. Okay, so this is your statement of shareholders equity, or the share statement of your partners capital, anything you can say. If it's a partnership firm, statement of partners capital. If it's a company, so you'll get a statement of shareholders equity. So statement of shareholders equity that we have yesterday also we have discussed the same statement of shareholders equity, where it will have, yeah, this was the statement of shareholders equity that was of the partners, that was of the company's shareholders, where you'll have common stock, how they'll get the share in common stock, retained earnings, and this was the total shareholder equity. This was the initial balance, net income, which was coming from the P&L statement, and the dividend, if any, distributed. At the end, they were getting the balance amount of the common stock, retained earnings, and the shareholders equity. So this was your statement of shareholders equity. Yeah, so that's all for today. If you have any questions, please contact BISP Solution. Thank you all for your time.